Good morning, good afternoon, or good evening, everyone, depending on where you're joining us from around the world. My name is Richard Anderson, and I'm the founder and CEO of ShareVault. I would like to thank you for joining our webinar today, and I will be introducing our speaker momentarily. This is the 23rd in ShareVault's webinar series, and today's topic, backed by popular demand, is the art and science of high M&A valuation. Today's presentation is especially timely given the very active technology merger and acquisition market we are all experiencing today, and which is forecast to continue through 2015. Each deal in the vast sea of transactions centers around a definition of and agreement upon value. From the standpoint of any seller, it is critical to understand the core aspects of the technology buyer's key valuation criteria in order to achieve maximum valuation for their assets. At ShareVault, we frequently work with customers and investment bankers who are wrestling with many dimensions of valuation, from market size parameters and trends to accretive technology and team alignment to customer synergies and beyond, as they manage these highly confidential and strategic conversations with prospective buyers. We will explore these very timely topics shortly, but let me briefly cover a few logistical items. First, although your individual audio will be muted in order to minimize background noise, we do encourage you to submit questions at any time during today's presentation via the question box located in your webinar control panel. Secondly, there will be a question and answer session following the presentation. Questions which are not addressed during this forum will be responded to via email after the webinar. And lastly, our speaker has generously offered to make today's presentation available for download. You will be notified by email when the presentation is posted, and login procedures will be provided to you. You'll then be able to access the presentation by logging into a ShareVault secure document sharing system. We at ShareVault specialize in supporting the types of collaborative, complex business processes and transactions which our speaker will cover today. And we are pleased to have the opportunity to provide a forum for discussing these important topics. We have a full agenda for today's presentation and discussion. We'll begin with the presentation, followed by a brief demonstration, and then move to an interactive Q&A session. Now, let's get started. It is my pleasure to introduce David Stastny, Managing Director of Centaur Partners. David is a recognized authority in strategic finance, corporate development, and M&A. He leads a team at Centaur which provides investment banking services to a wide array of leading middle-market technology firms. The Centaur team, which is aligned with Dresner Partners in Chicago, Silicon Valley, and New York, has completed $5 billion of M&A deals and $1 billion in private placements. David brings extensive experience in fundraising, M&A, transaction readiness preparation, and due diligence, occupying senior managing roles with Osprey Ventures, GKM Ventures, Soundview Financial Group, Oppenheimer & Company, and Robertson Stevens & Company. He has been the lead and/or senior banker on many premier technology IPOs, follow-on offerings, buy and sell side M&A advisory, hostile takeover defense, private placements, spin-outs, and restructurings. From the vantage point as a senior finance executive who has been involved in many diverse transactions, David has much to share with us today. We are very pleased to be with you, David, to learn from you as we discuss these very timely business topics. So welcome, and please feel free to begin your presentation.
Richard, thanks for the introduction. Just a moment on Centaur Partners. We're an M&A boutique technology investment bank. We also offer a very unique consulting service called Transaction Readiness, which helps companies prepare for either M&A events or venture capital events by helping them to anticipate and remediate any potential due diligence issues. You can see our organization has a very esteemed advisory board that are experts in various areas like IT services, IT security, digital media, gaming, etc. And we're affiliated with a much larger firm called Dresner Partners out of Chicago and New York that have done over 400 M&A transactions. So a little bit of our resume. So we're going to talk about a few things today. First, what has been the tech M&A velocity? What is a potential acquirer's view of your company? And what are the areas they're going to focus on? Finally, a conclusion, and we'll talk a little bit about areas of diligence that are critical to getting the deal done. So first, tech M&A velocity. The capital markets in 2014 and in 2015 are very strong. You can see that over the last 12 months, internet and digital media, which is probably the most high velocity sector, is up 24%. The security index is up 23%. NASDAQ as a whole up 18%. Big data, which is becoming a more interesting M&A area every day, up 15%, and SaaS up 9%. 2014 was the highest velocity tech M&A year in quite a few years, and we see 2015 to be at that level or greater. So as I said, M&A activity was very strong and is projected to continue in 2015. The large IT companies have been extremely profitable and they're flush with cash. Also, their market caps and market values have gone up dramatically, which makes them want to buy at high valuations. Just for an example, we're finding the average valuation in the SaaS marketplace for high growth companies to be about 4.5 times trailing revenue, which is the highest we've seen in a very long time. Also, for larger acquisitions, the credit markets have gotten very aggressive in lending to both public and late-stage private companies for them to make acquisitions. Some of the numbers, the M&A market saw deals worth $383 billion in TMT just in the first half of 2014. It was the highest first half record volume that we've ever seen. Above the subsectors, telecom, which is broadly defined, was the largest with 89 deals worth $236 billion. The largest 5 deals in North America contributed 62% to the TMT activity, and the global M&A volume reached $2.8 trillion in the first 9 months of 2014. These are incredible numbers, and we go into 2015 with an incredible pipeline of deals getting done. So it's a very, very good time to sell your company if you're ready. A couple of representative transactions, SAP, Hybris, Salesforce, ExactTarget. And it turns out that the M&A market in tech is becoming extremely concentrated. Of the top 10 companies with the highest cash positions, 5 are tech companies. And you know the names: Microsoft, Google, Cisco, Oracle, and Apple. This is a chart of the velocity of acquisitions by the largest acquirers in the tech market. And as you can see, from 2009 through 2014, the number one highest velocity buyer was Google. However, some of the historical buyers have still been extremely active, such as Cisco, IBM, Oracle, and some new groups are buying a lot more than they used to. Folks like Amazon, Dell, EMC, Salesforce.com, SAP, and VMware have gotten into the elite group of more than 20 deals in their M&A portfolio. These acquirers are the most active, and we consider them to be continuing to be the most active in 2015. Here are some of the deals that the most active buyers have been acquiring. And there's a misconception that big companies don't want to buy small companies. That is a misconception. If you look at some of the acquisitions made by the Amazons or Cisco's or Google's, some of these are very small companies. In fact, some of them have little or no revenue, but they have IP, they have good teams, and they have a unique position that the buyer can use to infiltrate new markets or sell as a bundle with their current product line. So now let's talk about the potential acquirer's view of your company and what are they going to look at and what are they going to focus on. So to start out, tech companies are bought, not sold. However, the buyer must be preconditioned and attracted to your company. It is extremely competitive in this marketplace. Companies like Google and Cisco and VMware see thousands of potential opportunities a year, and they might do 5 or 10. So how do you differentiate your product, your company, and your opportunity? Your company needs to be ready for the diligence when the buyer comes courting. If you try to prepare for the diligence that's going to come from a sophisticated buyer without pre-preparation, you're probably going to fail. You're probably not going to be able to get your deal done. Your team and investors have to take an external view of your company, and you have to remediate any of the weaknesses or issues prior to the buyer's diligence. With me today is my partner, Glenn Gottlieb, who runs our transaction readiness practice, and he'll be available for questions after this webinar. So how do we know what kind of diligence areas are the buyers and in many cases investors? Many of the things we'll talk about today also apply to institutional venture capital investors. So first and foremost, you have to prove that your company operates in a sector which has a very large total available market, whether that market is North America, Europe, or all the world. However, it's very important for you to show a potential buyer that you've had success in particular verticals, medical, finance, retail, or a particular region. You need to show that you have some special sauce in order to be able to garner more than your fair share of the market and have an ability to grow on a national or worldwide basis. Also, will your company contribute to significant revenue growth from the acquirer? And one of the things we like to see is the CEO and the head of business development talking to a buyer say, just add water. We have 5 salespeople, you have 500. We can bundle and link with your product, and our product can be sold through your bundle immediately. And we can take our sales from 5 million to 50 million, and here's how it is. Just add water. Never that simple, but that's a presentation we like to be able to give. The management team is very important because most buyers will retain most of the management team and expect them to run this product line or division for several years. So it's important to have a prior history of success with the management team working together. Many of these buyers love to see a team that's on their second or third deal together because they understand that working together is critical. That you need to have proven superior leadership skills, and they're going to test those during the due diligence process. They also like to see broad operating experience. You might be doing a very good business at 5 million in revenue, but when they introduce this to their sales force and their product development group, it may spike the sales dramatically. So they want to see a broad operating experience and very adaptable, because once you're acquired into a company, what you do on a daily basis is going to be much different. Also, they want to see extremely good internal chemistry. Many of these buyers will actually do personality tests in which they take the management team and try to see, are they compatible to continue to work within this organization? Clearly, if you don't pass the personality test, it's going to affect your valuation. The other thing we need to see is we like to see a consistent message. Sometimes a buyer will bring the management team individually into conference rooms and spend a half day with them. And if they get an inconsistent message, the value will be lower or the deal will be blown up. The technology team is extremely important. They want a specific dominant vision. They want to see that all the oars are pulling the same way in the boat. And they want to see that you have unique product design skills. And how do you prove it? How do you prove how unique your product is versus all the other competition that surrounds you? Proprietary intellectual property used to be more important, but it still is important. Do you have patents awarded? Are they defensible? Are large companies stepping on your patents? Is there a way to extract some value from those patents? Do you have patents in process? And when do you think they'll be awarded, and what's the probability that they'll be awarded? What are your trademarks? What's your branding? Have you protected your branding both in North America, Asia, and Europe? All of that is very important for a big company. Do you have a first mover advantage? Many small companies do. If you're not the first mover, how can you be a fast innovator? And why can you get to market? And how can you get to market to get your fair share? Are you operating in a protected market? And what are the intangible and tangible barriers to entry around your marketplace? The other thing that the buyer wants to see, and also venture capitalists want to see, is do you as a team have a laser focus on very clearly defined and tested business goals? Are they tangible? Are they measurable? And can they go back and see how well you've done against those tangible business goals in the past? Do you have a proven ability to lever your unique target customer knowledge? Most buyers love a team that's worked in medical or finance or retail or consumer. that have deep knowledge from the larger companies or other successful deals they've done in the past, because they want to see that unique barrier to market access. Do you have a demonstrated, repeatable revenue operating model? And in today's world, there's a lot more value for SaaS-based markets where you have a repeatable business model. If you're working with venture capitalists and in many cases M&A deals, what is the quality of your current institutional investors? Most institutional VCs don't particularly like to deal with angels. However, if you have angels, they're looking for the sophistication of those angels. Are these prior operators or executives from tech companies? Are these retired venture capitalists? Are these people who have come from IBM or Cisco or Google? Much stronger than having doctors, dentists, and so on. It's very, very important for venture capitalists, but it's also very important for the M&A deal. Are your investors fully supportive of taking actions toward an M&A event? It's very hard to negotiate a deal if the investors, the founders, the management team are not in alignment. And in some cases, because of prior economic investment, et cetera, they're not in alignment. Another important thing is, do you have seasoned, independent board members and industry advisors? Do you have what we call the gray hair factor? Somebody who's been in the business for 20 or 30 years helping you. Have they done it before? Have they seen all the issues that are going to come up in this M&A event, and can they help you through it? Current customer momentum. What is the new customer velocity? Is your product still meeting the needs of the marketplace in 2015? What's the size of these deals? What's the quality? Can you do a land and expand strategy, and can you prove it through case studies? Because clearly many of these companies that we see are smaller but have very large customers, and those customers could produce many millions more than they are. And how can you prove that you're landing and expanding in some of your potential customers? What are your high profile customers? And will they provide references? Because at some point in this, the buyer or the venture capitalist is going to want to go directly to the buyer and ask some very pointed questions. I had a situation not too long ago where our company was trying to get a deal with Cisco as a customer, not as a buyer. And we worked very hard to get that deal with Cisco. We paid one of our salespeople in the company a very high commission. By getting the Cisco account as an OEM, it increased the value of our company by 40%. One deal increased the value of our company by 40%. Can you show repeat competitive wins? Are you a darling of the press? And what are the industry analysts saying about you? What is Gartner, 451, Forrester saying about you? Hopefully you're on the quadrant somewhere, and hopefully they're saying good things about you. Competition. We've talked about this before. Are there special barriers to entry or advantages that make you unique? Particularly in some of the markets we work on, there are 30 companies, many of them with the same message. So what is different and what's your barrier to entry? Is your product technology leading a transition? If you're selling a product that competes with Oracle, you better be moving into a new transition where they can't catch up or where you disintermediate their business model, because nobody's going to buy you if you're competing head-to-head with Oracle on a similar product. Are you in a market that is one of the high growth sectors? We typically see the SaaS application and infrastructure companies as a good market. We see a tremendous amount of M&A in the big data market, the mobile migration market, et cetera. So are you in a market where the buyers will believe that you're leading a transition? Do you have a unique execution advantage? How do you get to market? How do you sell faster, cheaper, and more volume? What's your breakthrough solution? There's lots of mature technologies and products out there. How can you prove a breakthrough? What's your new technology or delivery model versus the incumbent? Because if you're competing at the edge of an incumbent's large market, you have to have something very different. Does your management team exhibit prudent, frugal cash management? Now, I know that sounds funny because we see companies out there raising 10, 20, 30, $50 million. But your investors and the M&A partner wants to see you can manage a dollar and you can do it very, very well. And then finally, and importantly, has any strategic investor or buyer approached? Because that always helps attracting new buyers. And the best thing to do is have a term sheet that's non-exclusive so you can go out to the market and shop it and try to bring multiple investors or buyers to the table to try to best the value, the terms, and the long-term opportunity of that term sheet. We're going to shift gears for just a minute here. We talked about all the positive reasons that someone might buy your company. Let's talk a little bit about what the deal market looks like from a negative perspective. And this is once you sign a term sheet, what could happen? What are the major areas that could cause that term sheet to go away? So the sobering reality is that with a study here, this is a Price Waterhouse study that they conducted several years ago, and it asked CEOs and CFOs who did deals what most impacted your deal. And the number one largest thing was more detailed information to the buyer for their due diligence. The other is performing more seller due diligence. So you as the seller should have done more due diligence on your buyer's remorse, so to speak. And then, of course, having more bidders in the deal. 31% said that would have more favorably impacted that. That's what our firm does. We bring lots of bidders to the table. So here's the sobering reality. Being prepared before the seller starts diligence is really important. Currently in the technology market, investors are backing away from approximately half the deals where they start due diligence. 85% of deals have a lower purchase price at closing than was written in the term sheet. Now, sometimes this isn't changing the dollar amount. It's making the money an earnout or an escrow or some kind of gates to get the money after the deal closes. And 67% of the deals have a lower valuation and tougher terms from the term sheet to the definitive agreement. So it's critical to address potential deal killers in advance, and you want to make your deal move faster. Moving fast is in the seller's best interest. Moving slowly and having a long time for diligence is in the buyer's best interest. Time is not your friend. And the more prepared you are before you start the process, the more probability you're going to get a higher valuation and better terms. So we have a service called Transaction Readiness, which assesses the major M&A risk factors and recommends a course of remediation action 3 to 6 months before you're in the market. The way we do this is we interview the CEO, CFO, and all the other key folks. We come back with a proprietary analytical overview of your company and give you the assessment areas that you need to remediate. That's the conclusion of our formal presentation, and I think I'll turn it over to John Badger for a ShareVault demonstration.
Great. Thank you very much, Dave, for the very informative presentation. We're going to do a brief demo now of ShareVault that actually connects some of the themes that we've just been talking about. So I'm going to go ahead and take over here. And I'm logged in here to a ShareVault, which is set up for due diligence on a company called Acme. And let me just quickly show you how ShareVault works and how it's used in the context of due diligence. And then after this, we're going to stick around for a Q&A session to cover some of the questions that have been coming in. So why don't I go ahead and take you through a brief demonstration. So this is ShareVault, and as you can see here, you have all your documents for due diligence organized here. There's a quick first page preview that shows up just by mousing over the thumbnails here, but you can scroll through your entire data room with this infinite scrolling feature, or you can focus in on specific areas of interest that might be of relevant to whatever documents you'd like to see. To view a document, you just click on it. In a moment, I'm logged in here as an administrator, so in a moment I'll log in as an end user to show how that works. The content is organized as tags, and that's a very unique feature of ShareVault. When you want them, basically they behave just like folders, but they have some additional advantages that we're going to cover in a minute that are very, very important for particularly tech M&A, and we'll show you why in a moment. There's also a very powerful search feature. So if I search for the word liability, it's going to show me instantly all the documents that contain, even within the text of the document, that word. And you can then open to find the document, to find the word. When you're setting up as an administrator, you have the ability, anybody can ask a question at any time. You can administer questions and answers through the Q&A facility. You can also configure ShareVault to apply different document security rights on a per document basis. So here you can see these documents are only allowed to be viewed as a PDF. You can disable print if you want. You can also disable copy paste, apply watermarks, prevent saving of the document. If I go over here to the reports page, you can see that there's an ability to visualize exactly who's seen what document and when, which is very important in the context of due diligence. And you can also look at this on a summary basis. This report here is very useful because on a per group basis, you can see which of your groups have had the highest degree of activity. It tracks a number of files accessed, number of pages viewed by each group, or you can drill down to the user level as well, and the amount of time spent. These are really unique features, and you can find out, for example, how much time a given bidder is spending on your regulatory documents as a whole. And during due diligence, it's really useful information as you go through the process. Let me go back to the documents page and illustrate something regarding tags that is very, very useful. As David mentioned during the presentation, tech companies tend to be bought, not sold. So what that means is that typically you're going to be approached by a potential buyer and then the list grows. And that's, Dave's job is to make that list grow. But because the process typically starts with an initial buyer, your initial due diligence list will come from the buyer's corp dev department. So now what happens when this next bidder comes in, you've got this M&A due diligence list that was specified by the first buyer. It can actually be more important to organize it in a way that's related to what Dave advises you, because Dave's very good at designing due diligence lists that sell. So what ShareVault allows you to do through tagging is to very easily put a separate set of tags for a separate set of users. So here's an example of how quick and easy it is to do that. So I've gone into edit tags mode and I'll hop over here to Excel. Let's say that this Excel spreadsheet has this hierarchical organization of your documents that's been given to you by Dave and his team. I just come over here, I copy these tags, I go back into ShareVault, and I can add the tags just by pasting them right here into the edit tag mode. And it basically has created these tags for me, and I can go ahead and get out of the edit tags mode and come in here and just drag and drop the files that pertain to one due diligence, just drag and drop them onto this new due diligence list. So you can basically take the contents that are already in your ShareVault based on the organization from your first bidder and reorganize them for additional bidders using this powerful mechanism. So that's the capabilities that the tags capability offers within ShareVault. Let me quickly log out and log back in as an end user here. And this will give you an idea. First of all, a confidentiality agreement is shown that's totally configurable by you. And then the user clicks through to actually view the documents themselves. And here, the user can scroll through, find a document of interest. And when the document opens, it opens in this secure viewer that has the watermark on every page. And you can just flip through the pages. This doesn't require any plugin, but it's a secure document viewer that blocks print, blocks save, if you want, applies watermarks based on who you are, so it identifies who the user is. So you have complete control and tracking of who's seen what and when. And this also obviously has the capabilities of search that can really accelerate the process of due diligence. So it gives you a degree of document control, document security that you need, the functionality of search, the organization of tags, and the permissioning facilities but it's all extremely easy to use. Everything is drag and drop and easy to organize. Okay, so that terminates the demonstration portion of the session. We're going to jump now into Q&A. So let me change the presenter again. If approached by a buyer and an offer is made, you've noted other buyers will come. At that point, do you suggest beginning a formal auction process? Might you use a go shop, or how else do you hold the original buyer in line?
That's why people hire us and pay us a very nice fee to do this. Keeping the original offer at the table, keeping it warm while you're shopping other cooler offers, trying to make them warm or hot, is an art, not a science. And that's one of the things we do very, very well. We understand how to manage a bidding process, a negotiation process, and we know exactly when is the best time to sign a no-shop agreement that locks you to one buyer for some period of time so they can do their due diligence. Good question.
Okay, next question is, can you discuss the pros and cons of asset-based versus equity-based transactions, especially from the seller's viewpoint?
In most cases, selling the company's equity is better for the seller. And because what occurs is the buyer is buying the company, its assets, its liabilities, its obligations. However, for a smaller company selling to a bigger company, many times, and the majority of times, it's now an asset-based purchase because the larger company does not want to assume the liabilities of the smaller company. And if you don't have audits that are acceptable audits, the bigger company won't take the risk of rolling you into their financial statements and then having a problem occur later. So it's better for the seller to sell the company. It's better for the buyer to buy the assets. And since the largest buyers now control a lot of the deals, more than half of the deals are now asset sales.
So can the M&A readiness analysis be purchased separately from a full M&A engagement agreement?
Yes. Our consulting group is separate and does transaction readiness analysis on companies that sometimes don't end up selling or may end up selling themselves, which I don't at all tell you should do, or in some remote cases, hire another investment bank. So yes, they are separate services.
Okay, another question here is for us here at ShareVault. The question is, how much is ShareVault? Looks great compared to Box.com. Can you set it up for me? So ShareVault is designed, has many attributes that are very well suited to the due diligence process that are absent from general purpose file sharing solutions like the one you've noted here. The cost is higher because it has a kind of a vertical aspect to it, but it is much less expensive than the other virtual data room offerings that provide that same degree of due diligence support. So, and it's extremely easy to use in comparison to those sort of older solutions. So the price point is in between, and that question was from a person who we will reach out to. And if you have any questions about pricing afterwards, please don't hesitate to call us. We also are the only virtual data room provider to provide a free trial that you can set up and experiment with. You can even upload all your documents and see how your deal is going to look before making any kind of commitment. There's also a question as to whether our service evaluates the quality of the documents, and do you review the documents in the data room to identify any possible weaknesses or gaps? That is actually more of a service that would be offered by a company such as Dave's. That would be part and parcel of the M&A advisory services to make sure that the data room does contain the right content to close the deal. ShareVault is a technology platform which provides the full suite of solution capabilities, but it doesn't involve the advisory component. We do provide, however, guidance on how to organize it at a high level, but it's not like we're going to get deep into a gap analysis like an investment banker would. How does a small company leverage to ensure their asset purchased by the large company is developed and not shelved?
I don't know if I understand that question. You saying that they buy your assets, they pay you, and then they don't use the assets? I think that may be what the question is.
Yeah.
You don't have much control over that, unfortunately. You know, it's a little like selling your car and then wanting to drive it the week after you sell it. If you've got a good product and if they've paid quite a bit and if your team stays together to help them to commercialize it to their much, much larger platform, you're probably in good shape. If your team dissipates quickly after the deal and they find gaps in the product or problems, they'll probably shut it down. Again, it's tough to control something once you've sold it.
Okay. And then this is going to be the last question that we have time for because we're going to tie up here. But this last question here is, would you help finding a tech company as a strategic partner as opposed to a full M&A?
Yes, we do that quite often. A company will come to us and say, let's try to find a strategic partner. And if that strategic partner ends up wanting to buy us, so be it. But we would take an OEM deal. We would take an investment. We would take a joint marketing agreement. So yes, we go into the market many times looking for a strategic partner. And sometimes that strategic partner becomes a minority investor, not an acquirer.
Okay, and here's a question from an actual ShareVault customer. Looks like he's wanting us to highlight an important aspect of ShareVault, so I'll go ahead and take the opportunity to do that. And thanks for the question. If we purchase ShareVault services, is it like acquiring a database where we have to learn and manage everything, or does ShareVault provide ongoing support? And that's an extremely good question because the answer is we provide 24/7 support. So anytime, day or night, you can call ShareVault and you'll be talking to somebody who knows the platform, knows the system, knows due diligence, knows M&A. And that means that, you know, if it's 2 a.m. and you're trying to get documents out to make sure that they are ready for due diligence in the morning, you just call ShareVault, and whatever you have a question with, we're right there to help you. And we also have screen sharing capability where we can come right onto your computer, screen share with you, and resolve whatever the question might be. So I think that takes us right up to the limit here on the presentation. Wanted to thank you for attending our webinar, and also thank Dave for coming over to ShareVault and doing this webinar for us. It's worked out really well. It's a good partnership. The contact details for Centaur Partner are here. And again, as a follow-up, you'll all be receiving an invitation to a ShareVault where you'll be able to download the slides as well as the slides for all of our previous webinars. And you'll soon be receiving, this will be early next week, a link where you can go ahead and view a recording of the webinar. And stay tuned because in about 6 weeks, we will be releasing a white paper which puts in written form everything that Dave has discussed in this webinar. So thanks again for your attendance, and we'll look forward to seeing you at our next webinar.